Assalamu alaikum. I'm Mohammed Kamrul Hassan. I'm completing my bachelor degree from Russia University under the Department of Banking and Insurance. My student ID is 18108371145. Today we will discuss about the measurement of risk-weighted asset, credit risk. Let's start. Credit risk means the potential that a bank borrower or counterparty fails to meet its obligation in accordance with agreed terms. Bangladesh Bank has also decided that banks may use the rating of the following international credit rating agency for the purpose of risk weighting their exposures at abroad. Fees, Moody, Standard and Poor. Methodology. The capital requirement for credit risk is based on the risk assessment made by external credit assessment institution organized by Bangladesh Bank for capital adequacy purpose. Banks are required to assign a risk weight to all their on-balance sheet and off-balance sheet exposure. Risk weights are based on external credit rating, which is mapped with the Bangladesh Bank rating grade or fixed weight that is specified by Bangladesh Bank. Collateral for credit risk mitigation. Where a transaction is secured by eligible financial collateral and meets the eligibility criteria and minimum requirement, banks are allowed to reduce their credit exposure or potential credit exposure to cover exposure under that particular transaction by taking into account the risk mitigating effect of the collateral for the calculation of capital charge. Calculation of capital charge. Where transactions secured by eligible collaterals, a bank need to first calculate the net exposure amount by taking into account the effect of collateral. The net exposure amount is then weighted according to risk weight of the counterparty to obtain the risk weighted asset amount for the collateralized transaction. On balance sheet netting. On balance sheet netting may be allowed where a bank has a well founded legal basis for concluding that the netting or offsetting agreement is enforceable in its relevant jurisdiction, regardless of whether the counterparty is insolvent or bankrupt. Is able at any time to determine those assets and liability with the same counterparty that are subject to the netting agreement, monitors and control its role of risks, and monitor and controls the relevant exposures on a net basis. It may use the net exposures of loans and deposit at the basis for its capital adequacy calculation. Guarantee for credit risk and mitigations. To reduce credit risk transaction by the secured by guarantees, where guarantees are direct, explicit, irrevocable, and unconditional, bank may consider such credit protection in calculating capital requirement through a substitution approach. Only guarantees issued by or protection provided by entities with a lower risk weight then the counterparty will lead to reduced capital charge since the protected portion of the counterparty exposure is assigned the risk weight of the guarantor or protector provider, whereas the uncovered portion retains the risk weight of the underlying counterparty. Thanks everyone.